Scalping is a trading style focused on quick short-term moves, ideal for those who don't have hours to watch the charts and prefer fast, decisive results. In this video, I'll walk you through 3 of the most effective smart money concepts and price action scalping strategies you can use to capture quick opportunities directly on your chart. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Before we begin, it's important to note that scalping strategies focus on short-term trades within lower time frames, especially during periods of high market liquidity. Because scalpers operate on these smaller time frames, they face more false signals and must manage risk with precision. It's also best to focus on major pairs with tighter spreads, since every pip counts when targeting moves of just 10 to 20 pips. Most trades are completed within an hour, making scalping perfect for traders who want quick results without spending too much time on the charts. So, here's a quick checklist every scalper should review before analyzing the market and placing trades. Now, let's move on to the first scalping strategy. In this setup, we use 2 time frames, the 30-minute and the 5-minute charts. On the higher time frame, we analyze the market structure to identify the overall direction. We look for breaks of structure, BOS, and changes of character, CHO, to confirm the trend. Then, we manually mark the fair value gaps, the zones that highlight the best areas to look for potential trades. Once price returns to those gaps, we switch to the lower time frame. On the 5-minute chart, we wait for a clear entry signal, typically when a liquidity grab pattern appears. After spotting that setup, we enter the trade and define our targets. This approach works because it combines 3 key elements: trading in line with the trend, taking entries from strong supply and demand zones, and using lower time frame confirmation for precision. Now, let me show you how this works directly on the price chart. In the first step, we identify the market direction by marking breakouts and changes of character, or BOS and CHOCH. These can easily be drawn manually using simple trend lines and labels to visualize structure shifts on the chart. Start by marking each break of structure that confirms trend continuation and each change of character that signals a possible reversal. These 2 elements form the foundation of market structure analysis. In this example, we can see the price breaking structures to the upside on the 30-minute chart. That means we're in an uptrend and should focus only on buying opportunities. Next, let's talk about fair value gaps. These are imbalances on the chart, zones where price moved so quickly that it left a gap between candles, creating an area of inefficiency. The market often returns to fill these gaps as it seeks balance. We'll use these manually marked gaps as key zones of interest, expecting possible price reactions when price revisits them. First, wait for the price to trade back into the gap, then move to the lower time frame to look for confirmation signals before entering a buy position. So, let's switch to the 5-minute chart. On this lower time frame, the goal is to spot signs of a possible reversal. One strong clue is a bullish liquidity grab, when price briefly wicks below a previous swing low before reversing upward. This move shows where stop losses were triggered, followed by a sharp reaction in the opposite direction. Liquidity grabs often occur near key zones like fair value gaps and can serve as powerful entry confirmations. When this move also breaks a recent bearish structure on the lower time frame, it gives us extra confirmation. In other words, it forms a change of character. Now it's time to execute the trade. Place your stop loss just below the low of the liquidity grab and set your target at the next key level identified on the higher time frame. In a bearish setup, start on the higher time frame by confirming a clear downtrend marked by lower lows and lower highs. Then, manually outline the fair value gaps as potential supply zones. When price retraces into one of these areas, move to the lower time frame and look for a bearish liquidity grab just above a recent swing high. Enter the trade once confirmation appears. Set your stop loss above the liquidity grab and aim for the next major support level below. Finally, always apply solid risk management to protect your capital. Stick to your plan and stay disciplined, avoiding emotional decisions. This strategy performs best in trending conditions, not in sideways or choppy markets. Keep learning and reviewing your trades to keep improving over time. Let's move on to the second scalping strategy. This setup has three main parts: a draw on liquidity, a liquidity grab, and the entry. So, what is a draw on liquidity? It simply means identifying a key liquidity level that price is moving toward. In other words, the market often moves toward areas with resting liquidity, such as equal highs, equal lows, or sharp reversal points, because that's where many orders are waiting to be filled. You can mark these levels manually by drawing lines across equal highs and equal lows, or by highlighting clear buy-side and sell-side liquidity zones on your chart. With that in mind, the first step is to locate a major high or low on the 30-minute chart that price is approaching. In this example, we have buy-side liquidity on the 30-minute chart, and price is being drawn upward toward it. We can anticipate that move, since liquidity tends to attract price. If a clear draw on liquidity isn't visible on the 30-minute chart, zoom into the 15-minute chart for more detail. Next, we look for a liquidity grab in the opposite direction of our draw on liquidity, this time on the 5-minute chart. So let's switch to the lower time frame. Keep in mind that in this case, the buy-side liquidity sits above us. At this point, we're looking for a swing low to be taken out, a sign that price may continue moving upward. You can enter the trade as soon as price returns inside that range. Alternatively, a more conservative approach is to wait for confirmation. Let price push higher to confirm the reversal. Then identify a manually marked fair value gap to set a buy limit. If no clear gap appears on the 5-minute chart, zoom into the 1-minute chart for greater precision. Let's quickly recap the bearish setup. In a bearish scenario, start by identifying a major liquidity area that price is moving toward, such as a previous low or a level packed with stop losses. These zones often attract price before a reversal occurs. Then, switch to the 5-minute chart and watch for price to move above a recent swing high before snapping back down. This action shows a liquidity grab, suggesting the market may start trending lower. Next, open a short position and place your stop loss above the high of the liquidity grab. Allow price enough room to move. Avoid keeping your stop too tight. For your target, aim for the next clear sell-side liquidity level. This keeps your trade structured and intentional. Now let's move on to the final scalping strategy, one that's completely based on pure price action. This method uses just a single time frame, and you can choose whichever best fits your trading style. First, identify the market direction to decide whether you're looking to buy or sell. Trading in the same direction as the dominant trend increases both confidence and consistency. What we want to see here is a clear trending environment. In an uptrend, price should form higher highs and higher lows while respecting the previous swing lows. In a downtrend, it should create lower lows and lower highs while respecting the swing highs. In the case of an uptrend, wait for price to form equal highs and then break above them. From basic price action principles, we know that when price revisits this breakout zone, previous supply turns into demand, meaning there's a stronger chance for price to bounce back upward. So we wait for a pullback into that zone, and then look for confirmation before entering a trade. You can enter once a candle closes above the previous candle's high. That's your signal that the level is being respected. If there's no confirmation and price keeps falling, simply skip the setup. You can also zoom into a lower time frame to refine your entry. After price returns to your demand zone, switch to the lower time frame. You'll often notice a short-term bearish correction, which represents the pullback from the higher time frame. Draw a trend line across the wicks with the most touches and wait for price to break above it. Once that breakout occurs, you can open a long position. Place your stop loss below the swing low and set your first target at the swing high. This confirms that the short-term downtrend has ended and price is ready to continue upward, following the main bullish trend. Now let's look at the bearish version of this setup. In this case, the higher time frame shows a clear downtrend, with price consistently forming lower lows and lower highs. What we're looking for is an equal low followed by a clean breakout to the downside. When price pulls back to this breakout area, the previous demand zone now acts as supply, meaning there's a stronger chance that price will reject this level. For confirmation, wait for a candle to close below the previous candle's low. That's your signal that sellers remain in control and it's time to consider a short position. If that confirmation doesn't appear and price keeps rising, simply skip the trade and wait for the next setup. For a more precise entry, zoom into the 5-minute chart. You should see a small bullish correction, a short-term uptrend against the main downtrend. Draw a trend line across the lows of this move and wait for a break below it. Once it breaks, you can enter a short position, place your stop loss above the recent swing high, and set your first target at the previous swing low. This setup shows that the short-term pullback has ended and the price is ready to continue downward with the overall bearish trend. Keep in mind that you can always check the higher time frame to see where the price is positioned in the bigger picture and whether your analysis aligns with it. For example, if there's a key market structure level right in front of the price, there's a higher chance that the setup will fail. That's because when the price reaches this level, it's likely to get rejected by the market. So always check the higher time frame to make sure there's enough room for price to move in your direction before reaching the next key level. That simple habit keeps you aligned with the broader market flow and helps you avoid trades that run straight into major structure. Together, these 3 scalping strategies form a complete framework for trading with structure, precision, and confidence. Whether you prefer smart money concepts or pure price action, the real edge comes from consistency, following your plan, managing risk with discipline, and refining your execution through continuous practice and review. Over time, that's what turns a setup into a skill and a strategy into real trading mastery. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader Community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.